Good evening, guys. I'd like to talk to you today about understanding the world of venture capital and how one guy, actually two, turned a $5,000 investment to $24 million. Who I am, my name is Pedro Moore, serial entrepreneur, venture capitalist, a VC advisor to some seed funds and Damon John of Shark Tank, and also I'm an approved franchisee because I'm actually working on acquiring a business, a franchise, Auntie's franchise, existing store. But let's go ahead and get right into it. The reason why I wanted to talk about this, a lot of people want to know kind of what I do. And even though the world of venture capital has become more popular and a lot more people understand or be involved, there's still a lot more other people that don't really understand. I think it is great to just share the knowledge to help others to understand how this world works and why there's so much excitement about it, because how people can make so much money in this world. Starting off, I'm just going to highlight the startup life cycle, the financing cycle of any startup company. Typically, there's this concept, we start off to the left where it's just an idea. And normally on the left of this line is we call this the valley of death, just because these companies are really risky. They're most likely to fail. And the reason why venture capitalists exist is because the fact that it's hard for them. They don't qualify for other finance like loans or anything like that, because these companies are dealing most likely high growth company. They may not be profitable, so these need fuel to keep continuing to grow. Once you get past this line, you get into the first round of institutional funding, and then you just kind of go up that ladder. As you can see, that red line keeps continuing up, and they're considered definitely they're past the valley of death, but you can start considering more mature companies and they become less risky to invest in. Now, that means also the share price is much higher because they are a lot more valuable, but less risky as well. This is a chart that came out when Uber went public a year or two ago. And I just think this is just an amazing to just kind of highlight how people make money. And as you can see all the way at the bottom, Mike Walsh and Oren Michaels both put in a $5,000 investment and made $24 million on this deal. Now, that's with the assumption that that's based off the IPO price, I think $45 a share. Now, I don't know if they sold their shares beforehand. I don't have all that detail. I'm just going off of this right here. But I just wanted to walk through the path of how they actually made $24 million off that $5,000 investment. I'm using a website called EquityZen where you can actually invest in pre-IPO tech companies, but they have these charts that shows the path to IPO, and it has a lot of other tech companies too. But as you can see here, each series, which is basically each round of funding for these startup companies, they have their total round of funding that they obtain for each round. For their very first round, they only raised a 1.6 million. And you can see the price per share. Okay. So, and what I did a little bit of research, here's what I believe, that Mike and Oren also, they invested at this stage at 1 cent per share along with first round capital. And I did some math and I don't know exactly how much they may have bought or whatever, but my assumption is that maybe they bought, like, with that $5,000 investment, 500,000 in shares, so 500,000 shares with that. So as you can see, their very next round of funding, which is their first, and keep in mind the reason why this is so cheap. This is the first round of funding. It's a new company, so a lot of things can go left or right at this stage. It's still considered extremely risky, right? So that's why they're so cheap. And a lot of companies do fail at this stage. And a lot of companies still fail at this stage. The VC firm I was with, this is where we actually invested at this early of a stage. We didn't invest in Uber. We obviously didn't had opportunity, but we invest in other companies that are raising their first Series A round. But you can see still under $1 a share that you can get in. So already those two gentlemen already made money from their initial investment. But as you can see, it just keeps moving up. Each time they raise a new round, their value goes up and their price per share goes up, which impacts their total value in the company. And as you see, all the way to the IPO, It was, I think they originally got it down to around like $48. I'm sorry, 45 for the IPO. And I think that this chart that I was illustrating is based off of the $45 per share. So that's where to get those numbers from. But as you can see, just the path, and anybody can invest in these. Well, not anybody, credit investors or venture funds or private equity funds can invest. But as you can see, the later you move down, the more valuable the startup becomes, and the higher the price it becomes as well. And it just shows. Now, keep in mind, you can invest at these later stage if you are an investor, credit investor, but you may not make as much money as those two gentlemen who the one Mike Walsh did by investing early at this stage. So there's pros and cons to both sides. You can be a later stage investor and you still make money, good amount of money potentially, because even these guys, I think their current price is around $28. So this guy who did a Series D round, this is also the assumption that they still all have a position in Uber, because these guys, even down here, position. Right? We don't know. But today, everyone from this right side is losing money. The hope, of course, was that the IPO at 48, and it keeps going up. And so that way, even Toyota, who bought in at $48.78 a share, could still make money on this deal. But I just want to kind of show you the path of how that $5,000 investment turned into $24 million. A lot of people are thinking like, that's crazy. Now, keep in mind, in the world of venture, that doesn't always happen to all VC funds, right? And you can make money because also you can get acquired. You can buy in at this stage, and then someone buys it at $4 a share. Boom, you still make money. But the people who get these big juggernaut type of deals, it's a small percentage of the VC funds that are all out there. First round capital, benchmark. These are some of the leading edge VC funds throughout the entire world. So they're the people behind a lot of other heavy tech companies, Snapchat, Facebook, whoever. But I just wanted to highlight the path and how that actually works. Basically, the reason why he made his $5,000 investment went to $24 million is because he got in at this stage. But thank you for your time. Be blessed.